Welcome to Beavers Wealth Management's October 2025 edition of Let's Talk Markets. Our goal, as always, is to educate, inform, and empower the families and businesses we serve. So, if you find today's discussion valuable, which I hope you will, we encourage you to share it with others who might benefit. So, in this edition, we'll start with a striking look at global confidence and U.S. markets as foreign investment reaches record highs. And then we're going to revisit the ongoing debate around inflation and interest rates and the Fed's next moves. And finally, since it's October, we're going to close on a lighter note by exploring, you ready for this? The pumpkin spice economy. A fun but meaningful reminder of how consumer behavior can actually drive sales. So let's start with this. Global confidence in U.S. markets. Now, this is a striking fact. Foreign investors now own more than $20 trillion in U.S. equities. That's roughly 30% of the entire U.S. stock market. It's actually the highest share on record, with data going back nearly 80 years. So, what does that really tell us? Simply put, when investors around the globe, they look for the safest, strongest, and most innovative place to put their dollars, they continue to choose the United States. So really, it's kind of a vote of confidence in the resilience of the American economy, our financial system, and our market's ability to deliver returns. And so take a look at this. When you zoom in on why this is, the picture becomes even clearer, right? Look at this chart. 7 of the largest companies in the world, which we've talked about before, they're all U.S. tech giants. NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, and Broadcom. Together, these 7 are worth more than $20 trillion on their own. Out of the top 25 global companies by market cap, you ready? 22 are American. This is what global dominance looks like. It's not just capital flowing into the U.S., but U.S. companies leading the charge in size and scale and innovation. But for investors, it's an important reminder. The U.S. remains the anchor of global portfolios. Even when the headlines point to uncertainty, global capital is still voting yes on America. So, as we dive into October, a month that's already started with a lot of noise, right? It's worth keeping in mind the U.S. remains the world's financial superpower, and the rest of the world is showing it with their checkbook. Okay, now Ryan's market fact, and he coined this fact consistency versus timing. Over the last 20 years, this is such a cool chart, $2,000 invested annually in the S&P 500 grew to, and you can see here different areas based upon that initial investment, $186,000 it grew to with perfect timing. And what that perfect timing means is you're buying at the yearly low. Well, now let's say you just invested that money at the beginning of each year. $170,000 it grew to. What about dollar cost averaging, which is monthly installments? It grew to $167,000. What if you had the worst timing out there and you bought at all the yearly highs? It still grew to $151,000. If you were sitting in cash, it only grew to $47,000. What's the moral of this story? You do not need to be perfect to have and build wealth. Even bad timing investors who consistently put money in the market ended up far ahead of those sitting on the sidelines. The richest investors in the world aren't those trying to trade every peak and trough. They're the ones who stay invested. So remember, consistency beats luck. Staying disciplined in the market has historically worked far better than chasing the perfect entry. I thought that was an awesome market fact, so I hope you enjoyed it as well. And let's take a look at the kind of a market synopsis as we clearly do each time to give you an idea of where things currently stand today. So it's been a good year, right? And we've talked about some of the return numbers, but what I always look at is what have been the best performing sectors in the market this year. Technology has finally overtaken as the top sector and the number one sector for 2025. The sector is up 23.4%. Communication services right behind it at about 23.1%. And utilities, believe it or not, almost 20%. Those are our top three. Now, the bottom three sectors, all of them still positive. The worst one, consumer staples, up 3% for the year. Consumer discretionary at 4%. And real estate, 6% return for the year. Now, what about the Fed funds? We talked a lot about it the last Let's Talk Markets, but we currently sit at the Fed funds target at 4.25%. Inflation has ticked up a little over 3%, 3.1%, and unemployment also ticking up to 4.3%. And so that's just to give you an idea of where we currently stand from a market metric perspective. All right, but now the fun stuff, the big discussion. We're going to talk about inflation. We're going to talk about interest rates. What comes next? So if you've tuned in to Let's Talk Markets this year, you know there's one theme you've probably heard us talk about more than any other. It's inflation and interest rates. It's the thread that runs through nearly every edition that we've been talking about in 2025. And when we started this year, kind of discussing the progress being made on inflation, even in last month in September, we dedicated an entire segment to the Fed's first rate cut of the year, right? It was a 25 basis point move that marked a turning point after 2 years of tightening. But before we get too far, we should briefly touch on the government shutdown that began October 1st. Shutdowns, they're actually nothing new. We've been through them many times before, but the timing is worth noting. A prolonged shutdown could delay important economic data like jobs and inflation reports, which the Fed relies on to guide policy. But interestingly, though, markets have taken it in its stride so far. In fact, during the first week of the shutdown, from September 29th through October 3rd, S&P 500, believe it or not, actually gained ground. It's a reminder that markets often care less about the bad news itself and more about whether outcomes are expected. And this was expected. So with that context in mind, let's turn back to the real driver of the moment. We've talked about this before. It's inflation. It's interest rates. What are the Fed's next steps? The Fed's preferred metric, which is core PCE inflation, it actually rose to 2.9% in August. That's the strongest reading since February. And the upcoming CPI report on October 15th is expected to show inflation around 3%, potentially the highest for the year. And that tells us something important. Inflation progress has stalled for the moment. Now, prices are still well below the 5 and 6% levels seen a couple years ago. But the final stretch back to 2%, which the Fed has said it wants to go to, it's proving to be the stiffest. And you can see, markets remain optimistic. Futures currently price in about a 90% chance of a 25 basis point cut at the Fed's October 29th meeting. We're stuck in kind of what feels like a classic balancing act, right? Because the Fed, it's got to manage inflation that's holding in a bit too hot, but it's also got to weigh external pressures, right? So signs of cooling in the economy, a softening labor market, and credit stress as well. And so if the Fed cuts now, it's signaling belief in this disinflation path. But if inflation rebounds, that cut, well, it could feel premature. Look at the Fed's dot plot here. It shows why this balancing act feels a bit uncertain, right? The latest projections reveal broad disagreement among committee members, something we haven't seen in a long time, right? Some expect rates to stay higher for longer, while others anticipate a quicker path lower. Yet the overall consensus still points towards gradual rate cuts over the next few years. But another question does loom. If October brings a cut, do we still expect one in December? Whether that holds depends heavily on that mid-October CPI, which we're going to be getting next week, future labor data, and whether the shutdown delays or muddies these signals. Okay, so you're asking yourself, as investors, what do we take from all this and why is it important? There may be noise in the short run, from inflation surprises, Fed speeches, or shutdown headlines, but really the broader picture offers reasons for optimism. In last month's Let's Talk Markets, we walked through historical data showing that both stocks and bonds tend to do well once rate cut cycles begin. That's one of the structural tailwinds that we're watching very closely. Also, another important point, the fourth quarter, we've talked about it. It's often been the strongest quarter of the year, with average equity returns higher than any other quarter. In years where markets were already up going into Q4, the upside has sometimes been even more pronounced. So while uncertainty is real, and the shutdown adds kind of a wild card to this, the backdrop of easing rates, seasonal momentum, and historical tendencies gives us a reason to be constructive. Now, as always, we'll be watching this closely, right? It's one of the most important inputs into investment decisions in the weeks and months ahead, and we'll talk more and more about this in future Let's Talk Markets. Whew, a lot of economic data there, a lot of information, but because it's October, I mean, it just feels like the right thing to kind of switch gears here. Let's talk a little bit about the pumpkin spice economy. Because October, it's not just about the costumes and the candy and government shutdowns, right? It's also the peak of what we call the pumpkin spice economy. From Starbucks pumpkin spice latte to pumpkin flavored cereals and cookies and even dog treats, this seasonal wave has become a billion-dollar business. And it actually has real impacts on the market, which is why we wanted to talk about it today. Because the numbers, they're eye-opening. Take a look at this. In the US alone, pumpkin-flavored products generated over $800 million in sales in a single year leading up to the fall of 2023. Analysts actually estimate the global pumpkin spice market could gross $1.1 billion this year, growing steadily as more brands are jumping in. What's one of those? Well, Starbucks' annual launch of the pumpkin spice latte is one of the most successful seasonal rollouts in consumer marketing ever. Foot traffic data shows a sharp spike in store visits immediately after pumpkin spice lattes hit the menu. The drink itself has become a cultural signature part of the fall, and it tells you fall has officially arrived. So what's often overlooked is just how much planning goes into these seasonal campaigns, right? Companies start developing next year's fall lineup more than 12 months in advance. It seems insane, right? Supply chains, they've got to secure ingredients. Marketing teams build campaigns, and operations adjust distribution to handle the surge. So timing is everything, like anything in life, right? Launch too late, consumers may have already moved on to the holiday flavors. Launch too early, and you risk pumpkin spice fatigue, which nobody wants that. But for the brands, the payoff is huge. Seasonal products create urgency. Customers know that they're limited time offers, which drive incremental sales, right? They also support premium pricing, boosting margins. Think of it as a mini earnings catalyst baked into the calendar. Now, of course, there's risk too, right? You misforecast demand and you're left with excess inventory that eats into profits. But really, why does this matter for investors? The pumpkin spice craze is more than just a quirky consumer trend. It actually highlights how powerful brand equity and consumer psychology can be in driving results. Companies with strong brand loyalty and operational discipline like Starbucks or Nestle or Mondelez can harness seasonal demand to reinforce market share and margins. For investors, it's a reminder that not all revenue growth comes from new markets or technologies. Sometimes it comes from executing brilliantly on something as simple as flavoring a latte. So, as we enjoy our pumpkin lattes or our pumpkin bread, I even saw pumpkin spice scented wet wipes this year. Are you kidding me? it's worth remembering behind that pumpkin spice economy is a finely tuned business strategy and a meaningful driver of shareholder value. Hope you enjoyed that. That was an interesting piece today on Let's Talk Markets that I thought would be fun and appropriate for October. So, as we just discussed, markets, they're constantly changing, right? Over the past year, that's meant not just innovation, but also plenty of volatility, and we've seen that. But volatility creates opportunity. So if you have a friend, a family member, or colleague who could benefit from a trusted second set of eyes on their portfolio, we encourage you to share our Second Opinion service. And it's a complimentary review that can help ensure investments are aligned and risk is balanced. Opportunities aren't being overlooked. Because we've seen this firsthand, just how valuable this can be, especially in uncertain markets like we've experienced. So if someone you know might benefit, invite them to tune into our next Let's Talk Markets or connect with us directly at any time, because we'd be honored to help. We're so grateful you joined us today, and we encourage you to share this content with anyone who might find it valuable. As I said before, we have our replays of all of our Let's Talk Markets posted on our YouTube channel. And yeah, if you haven't checked it out yet, you should. It's also home to our Beaver Nuggets and our podcast Between the Bears and the Bulls. And as always, if you have any suggestions, any at all, on what you'd like to see from us, please let us know. We want to make sure that the content that we're providing to you and we're putting out is valuable. And so, as we wrap up this October edition, remember, markets can be tricky, but with the right plan, they don't have to be scary. And speaking of scary, what's a ghost's favorite room in the house? The living room. We'll see you next month for November's edition of Let's Talk Markets. And don't forget, leave it to Beavers.